Hello analysts, and welcome to the 360 Huntington Fund's video series on equity valuations. In this video, I'll be showing you how to retrieve and input the cash flow statement into your valuation model, as well as cover some basic concepts that you should be familiar with. Please keep in mind that additional information on importing the financial statements can be found within the course packet that is available to all registered analysts. Let's get started. So first you're going to need to go to Morningstar, making sure you have your valuation template, the most up-to-date, downloaded. Enter in the ticker symbol for the company you're evaluating. Click on Financials, and then Cash Flow. Make sure that the period is 5 years. It's an ascending order, that your rounding here is consistent with the balance sheet as well as the income statement, and make sure that it's in annual statement type. And you're going to click on Export. You're going to download it. Once it opens, it looks something like this. And you're going to need to copy and paste this information and reformat it into the valuation model. Now your model or your cash flow statement may not be exactly like this, but this is just for example purposes. So up top you'll have cash flow from operations, which is a measure of the amount of cash generated by a company's normal business operations, and it's important because it indicates whether a company is able to generate sufficient positive cash flow to maintain and grow its operations, or whether it may require external financing. It's calculated by adjusting net income for items such as depreciation, changes in accounts receivable, and any changes in inventory. Further down you will see cash flow from investing activities, which is an aggregate change in the company's cash position resulting from any gains or losses from investments in the financial markets and operating subsidiaries. Most importantly, for our valuation, it shows the changes resulting from amounts spent on investments in capital assets such as property, plant, and equipment, which is labeled here. Further down, you'll see cash flow from financing activities. This part of the cash flow statement accounts for external activities that allow a firm to raise capital and repay investors, such as issuing cash dividends, adding or changing loans, or issuing more stock. It also shows investors the company's financial strength, and a company that frequently turns to new debt or equity for cash, for example, could have problems if the capital markets become less liquid. Now, once you have copied and pasted all of this information in, for the sake of time, let's say that I've already done this. You're going to need to do a couple of forecasts here in terms of the net cash provided by operating activities, as well as the free cash flow itself, which is the operating cash flow minus the capital expenditures, and that equals a simple free cash flow. So you'll see variables for relative historical models. There are two models that incorporate some information here. There's price to cash flow from operations and a price to free cash flow. Now the reason that these are used is we use the price to earnings, which is net income, as you know, as a more comprehensive approach to looking at historical price to sales, which are ways of evaluating companies as compared to their peers. The way that we look at these two, the cash from operating activities and free cash flow, is that they're a bit more comprehensive than earnings. So price to earnings is more comprehensive and more useful than price to sales. And in going with that, you would assume that price to cash flow from operations is a bit more comprehensive than price to earnings, and then free cash flow takes into account the capital expenditures. So it's just a way to kind of tighten up your assumptions about price to earnings. So what you're going to do is you're going to need to look at operating cash flow as a percentage of sales, so that you can ultimately make a judgment call and an input here that will modify this figure. So you can see that operating cash flow as a percentage of sales takes the net cash provided by operating activities, divides it by sales. You can get a percentage of sales. Then you also need to use the operating cash flow per share, which is simply the same. It's net cash provided by operating activities divided by diluted shares outstanding. You'll need this for the historical relative models later on. Same thing with free cash flow. You just link it the same as percentage of sales, and then also divided by the number of shares outstanding. And then you do your forecast. It depends on what you think is appropriate here. If you think that operating cash flow could increase based on what the manager notes in the 10K or something that the company has indicated, you can make a justification for increasing it, but you could also use the previous year's percentage of sales just to kind of keep relatively consistent with what's been happening historically. You can see here there's kind of a trend down for operating cash flow as a percentage of sales, so it may be justified to use something a little bit lower, say maybe 9% or something along those lines. But you'll see that it's automatically modified here as long as you have the formulas in place. This also gives you an average, which you can use as well, but again, you're going to need to justify these input figures. Further down, you'll see variables for the free cash flow to firm model. Two of the important variables here that you're going to need are the depreciation as a percentage of sales, and then capital expenditures, or CapEx rather. So depreciation as a percentage of sales, pretty self-explanatory. Take the depreciation and amortization divided by sales, and you get depreciation as a percentage of sales. Same thing with capital expenditures, but for this, because CapEx is negative, see here, you need to make sure that it's the absolute value, because if you use a negative percent of sales, then what ends up happening is it messes up the formula later on in the free cash flow to firm model. So you're going to keep absolute value here. So it's the ABS, which is the absolute function in Excel. And you're just going to take the absolute of these numbers, put them down here. Once that's done, you're going to take that number and divide it by sales to get the percentage of sales. This is pretty much all you need to know and understand for the cash flow statement. Obviously, there's a bit more here, but for our purposes, this is really all you need to understand. Feel free to take it upon yourself to get some more information on this. Most of you should have taken accounting at this point, so you should understand a considerable amount more than what I've discussed here. Thank you for watching. There will be additional videos on historical relative models, as well as the net present value valuation model, which is the free cash flow to firm, and the dividend discount model as well. So once you've finished inputting all of your financial statements and making the appropriate assumptions, you can continue on to the valuation